turns into Postmates, kind of has this amazing ride, sells to Uber for a hair over $5 billion. Not a bad first angel investment. I had no idea about venture capital and I literally came here with 2 suitcases, currently investing out of our 7th seed fund. Writing a $2 or $3 million check is like pocket change for them. No US VCs operating in London. Of our developer tools companies see my investment and launched Darkly. Jeff was a very early investor in Fitbit, Eventbrite, Poshmark. I sat on the board of the Founders Pledge up and through tens or maybe hundreds of millions of dollars of donations invested in UiPath at $15 or $20 million.
Today, we get to speak to Andy McLoughlin. He's a partner at Uncork Capital, one of the best seed stage firms in all of Silicon Valley. Before joining Uncork, Andy was a really successful angel investor, backing the founders of Calm, Intercom, and Postmates, all at their pre-seed stage. And if that wasn't enough, Andy co-founded Huddle, which raised over $80 million in venture capital before its acquisition in 2017. On top of all of this, Andy co-founded Founders Pledge, which has helped entrepreneurs commit over $11 billion to charity. It's a phenomenal episode. Let's get stuck in. But just before we do, let me introduce this week's sponsor of the OpenVC Podcast, Intercom.com. Intercom help founders by making your customer service 24/7. Through their use of innovative AI, you can answer 50% of your customer needs instantly. Intercom is offering 1 year free if you use the code OpenVC, all in caps, at the checkout using the link in the description below. And let's get back to the episode. Let's start with something juicy. You co-founded Huddle, which was an incredible market leader in secure document sharing. What inspired the idea?
Yeah, I have a degree in economics, but I decided pretty quickly that economics wasn't for me, so I taught myself web design and web development. I went to work for a telco. I ran all of their online properties, like a smallish B2B telco. And one of the things they'd asked me to do was work with a third party to put in a document management application. I went to work for that company as a consultant. I became a product manager for them. And I was like, I could build something better than this myself. Around that time, I first saw Basecamp. Super lightweight, but like super easy to use. I was like, if I could combine the power of these kind of enterprise document management systems with the ease of use of a Basecamp, that might be a thing. But I had no idea about venture capital. I had no idea about startups. It was like, I'm just going to start a small business. And so I started it with an old friend of mine, a guy called Alistair Mitchell. He was the GTM guy. I was the tech and product guy. We didn't know what we didn't know. And I think there was definitely kind of like youthful naivete. We were both unmarried, no kids, living in kind of relatively inexpensive apartments in South London. So this was kind of the great financial crash as well. So I think we left our jobs at the end of 2006. And the idea was, look, we've got a bit of savings. We can live on that for a year. If it's working, then great. And if it's not, we'll just go and get other jobs afterwards. When you see an entrepreneur that has a young family and maybe doesn't have a ton of savings, that's remarkable. The fact, the conviction they need to kind of put it on the line. I feel like it was a little bit easier for us, thankfully.
Okay, so you've identified the problem as a customer, thought you could build a solution that was better. Was that all self-taught coding? How did you manage to execute on that vision?
It was, and I'm by no means a good coder. In fact, I'm a pretty terrible coder, but I could do enough to kind of build a proof of concept. When I was first starting to think about the entrepreneurial journey, I remember reading a book called The Beer Mat Entrepreneur, which was by a British entrepreneur. He started a beer company, and this is like his tips for getting started. And the one thing I remember reading that stuck with me was the way to a rich man's wallet is via his EA. And so the telco that I'd worked at, this was, at one point was a $3 or $4 billion FTSE 250 listed company. And I'd always liked the CEO, we'd always got on, but his EA, Kathy, was a good friend. So I pinged Kathy and said, hey, I'm starting, it's been a couple of years since I left the business and starting something new. I was wondering if Charles might be interested in potentially investing. And she's like, yeah, let me check with him. And she said, yep, he's available this time, give him a call. So, Charles was our first investor. He invested 150K of his own money into 2 people that, I think in retrospect, we had no idea what we were doing. But,
How much of a business plan did you have at that stage, or was it purely relationship based?
It was purely relationship based. There was an early version of the product that I walked him through, and we kind of talked a bit about how this would be used in his company and kind of why this was a pretty generic kind of horizontal use case. It's like, yeah, this looks great. And actually, Charles came on as the chairman of our board as well, so it was kind of with Huddle through the entire journey.
Amazing. I mean, you went on to raise over $80 million in fundraising, so You must be quite good at fundraising.
We got better as time went on, for sure.
You landed your first meeting with 150K.
Not bad. But yeah,
Not bad at all.
we raised our Series A in early 2008 from a UK VC called Eden Ventures, and I think at the time it was probably a £2 or £3 million round, which was like a decent size. Now that's like a small seed, and that kind of allowed us to get started. Because at the time, but up until then, we had one engineer that I'd hired, but at that point we could begin to actually step up and hire some more people. So we hired a couple more engineers. We hired somebody to run customer service and customer support for us. And at the time, in 2007, 2008, there weren't a lot of SaaS companies. London had a good startup vibe for mobile and consumer and gaming, but you could count the enterprise software companies probably on one hand, probably with half of one hand. We were kind of making up as we went along. Like, this is before the Lean Startup had been published. This is before AWS was a thing. At the beginning we were still provisioning servers on racks in Southeast London, and so we were bringing on customers, and sometimes we could get them up and running, but we'd be like, okay, shit, now we've got to go and buy another server because it's going to max out our capacity. I mean, I feel like such a grumpy old man now, because I'm like, you kids, you have no idea how good you've got it, right? Stripe for payments, AWS for scaling and infrastructure. It's a different world.
Yeah, it's definitely becoming a lot easier to start a company and get to the MVP stage, but I think that also leads to increased competition. So it's got easier in some ways and harder in others. Can you tell us about your first sale? Because you're two young kids living in South London, you've just built a scrappy product. I imagine it didn't fully function and there were some problems with it. How are you getting into senior conversations and being taken seriously in a B2B slow sales cycle?
A kind of self-serve model, and then these days we'd call it sales-assisted growth, which is when we saw somebody come through that we figured would be kind of a good upsell opportunity, we'd actually get in touch with them. Our very first customer was actually a contact of my co-founder Alistair's. It was a business called Firefly Tonics. They needed tooling to collaborate with various marketing agencies and design agencies. Today we'd call them a design partner, because they were helping us figure out like all the stuff that wasn't working. I still remember though the first time that we had a customer come in and pay, probably spending $100 a month, and we'd never contacted them, we'd never spoken to them, we had no idea who they were. And I remember thinking like, this is it, now we have a start, and once you have a start, the rest is kind of inevitable. Who knows how far this is going to go, but like something's going to happen at this point.
Amazing. So was that the moment where you thought you were really building something significant? People are coming organically. You didn't even have to sell.
It was so early. I mean, I think as I think about kind of what made me comfortable that this actually might be a thing. I mean, we raised our Series B from Matrix Partners in 2010. Actually, at the very end of 2009, I moved out to the US in 2010. And at the time, like it's not like today. There were no US VCs operating in London. It was extremely rare for like a Silicon Valley VC to come and invest in a Series A stage startup in the UK. And so that was like, oh shit, actually there might be. These are smart people. They've seen a lot, right? There must be something here if they're prepared to kind of take this bet, especially when you've kind of got this embarrassment of riches in Silicon Valley and they have, thousands of startups to choose from. And then I think, it was actually kind of that, and then again, being able to continue to grow. And the first time we launched like a big customer, like a £100,000 a year ACV contract, I'm like, okay, this might be a thing. We got to be in the Financial Times. I talked to people who were using it at work and like, we used to use SharePoint. This is so much better and so much easier. And so there was no kind of big bang. It was kind of this incremental, oh, actually, this actually might be something. And our view was, right, if it ultimately didn't work, we had an amazing ride and, we'd take that learnings and do something else. But we kind of, we were able just to keep going.
Incredible. I mean, you did reach the end with a great success. But can you remember any like dark days? Were there any real hurdles that you thought might have been too significant to overcome? I imagine moving across the Atlantic was quite a big challenge, to say the least.
I mean, I came out here for what I thought was going to be a year. I came out in 2010 for a year now, 15 years later, here I still am. And it was the same thing with, no family, no real commitments. It was kind of easy to sort of pack my bags. And I literally came here with 2 suitcases, figuring like, I'll get a cheap apartment and just see how it goes. But yeah, I mean, it's crazy highs and crazy lows when you're building a startup. Landing that first big customer is great. Kind of hiring an awesome engineer is great. But then also when someone decides, they're going to leave because they've got a job offer to go and code at Google and earn 4 times as much, that stings. And when you're a team of 5 or 6 people, losing a person can have a big impact. I mean, it can impact your roadmap, it can impact customers, it can impact morale in the company. But I think what we learned was that people that kind of opt into startups, people that are okay with kind of taking that early risk, are generally kind of more resilient than you might initially give them credit for. And, as we'd have, and people are always turning over and leaving, you always really worry, like, is this person going to upset the rest of the team? And generally people are like, no, it's completely fine. If it's not for them, that's fine. Or maybe they were like, oh, thank God, because they actually weren't as good as we thought they were. People just get on with it.
Oh, yeah. Startups are always competing because you can't pay as much as the big players, and it's always riskier for the employees. It's culture, more than anything I hear, is what keeps people engaged and
that's
aligned
right.
on the mission.
That's right. And I think the more and more people understand the value of stock, I think especially out here in Silicon Valley, people have seen joining as an early employee, joining as like an early engineer, first salesperson, you can make life-changing money with that. And if the company sells, that's great. Then you go and rinse and repeat and do it again, and hopefully get there even faster. That didn't really exist in the UK. There hadn't been a lot of kind of big exits where people could kind of point to it and say, okay, this is actually going to give me life-changing wealth. And so, you'd have to convince people that this bit of paper they're getting with stock options might be worth something one day, but also being very clear that it might not. That's the gamble you're taking. 80-90% of startups ultimately fail or don't make real money, and so you're hoping that the company you join is going to be one of the outliers.
100% correct. It's a risk and everyone should be aware of the risks, but the upsides are phenomenal. And if you are an early employee, you deserve equity. You deserve sweat equity.
Absolutely.
You're aligned on the journey.
Absolutely. I mean, I'm a big believer that everyone in a company should have equity, from the founders to the C-suites all the way down to the person kind of working on the front desk. I think you want everybody to feel kind of, part of the company's success.
Modern day VCs are very concerned with the amount of equity going to startups, and often they ensure that the C-suite team and maybe others are coming into an option pool. So it's becoming necessary. Yeah. Okay, so Huddle's absolutely off the races. You've got some liquidity coming now, and you start making some angel investments. And the very first angel investment you make is incredible. Well, I don't want to spoil it yet, but what was it and how did it come about?
Yeah, so we when we raised our Series B, I was taught the notion of secondaries, and I'd never really come across that concept before, where you could sell a bit of your stock on the way through to incoming investors. And again, investors have a really smart long-term view typically, which is they don't want their founders to be worried about making rent. So they are increasingly comfortable to a point with the founders selling a bit of equity. Now, we sold a very, very small chunk. I think it was like $150,000 worth of stock at the Series B. Basically paid down credit card bills, meant that I could cover rent for the next year or two without worrying. And then there was a bit.
And how large is the Series B? Just for context to the founders today that are taking a few million maybe off.
The Series B was a $10.2 million round.
Okay, and you found 150K for you and your co-founder to just get back to even.
Yeah, exactly right. After I'd paid off kind of the various bills, I had a small chunk just sitting there. And around that time, a friend of mine from London, German guy, was moving out to San Francisco and was living at my place. And he was getting his business off the ground. It was called Curated.by. It was going to be a social media curation tool. And I remember I actually found the email recently, and I was like, Basti, I think this is a awful idea, but you're great and you'll figure something out. Now, of course, this thing didn't really kind of work out as he had planned, but after a couple of twists and turns, this company became Postmates. So when I'd invested, it was really, a bit of cash to kind of help him get started. He also wanted to find somewhere to live and get incorporated. So we did it on a convertible note at, I think, a $1.5 million cap. I invested $10,000. Ultimately, business turns into Postmates, kind of has this amazing ride, sells to Uber for a hair over $5 billion at the end of 2020. So, not a bad first angel investment. I wish they were all that great.
That is phenomenal. And when you invested that 10K, was that when you didn't believe in the business at that point? It hadn't pivoted yet into Postmates. It was, again, based on relationships.
Yeah, I mean, it was someone that I deeply trusted, someone that I deeply admired, someone who I knew would figure it out. And I think as an angel, you can make bets like that. As a VC, you'd be irresponsible to be kind of spending your LP's money without kind of, conviction, at least on the space. Although one of my friends, a guy called Hunter Walk from Homebrew, has a great phrase that I love. When they were investing, he'd say, "We invest in founders we love, building businesses we don't hate."
Okay, so founder first, and just ensuring that the business isn't,
exactly.
The model does actually it has potential to have a venture return size exit. Okay, so you're off to the races with Postmates. But you accumulate this incredible angel portfolio, including Calm, Pipe Drives, Secret Escapes, and Tray. How are you finding these opportunities as an angel? You're busy as a founder already, and you're finding really incredible deal flow.
Yeah, I mean, it kind of became my evening hobby. I kind of, I started work at 7 every day because of the overlap with London. I'd be working till whatever time, and then in the evening I'd just be at home, or I'd go out and meet founders, and a lot of them were Europeans, either Brits or other Europeans who were coming out here, and having been here for a year or two at this point, and kind of figured out some of the intricacies of landing in the US, living in the US, kind of building a network here, and I could basically say to them, I can be very helpful with all the things that you're going to have to figure out. Plus, I'd love to invest a bit of cash as well. And some of them were people that I knew already. So Alex and Michael from Calm were old friends. I knew the guys at Secret Escapes as well. But some were people that I just met randomly. I met Owen McCabe from Intercom at a party in probably 2012, and we went for a beer at the Irish Bank a couple of days later, and he talked to me about the vision that he had. I was like, that sounds great. I would be a buyer of this product. I'd love to invest. And then, but one story that I love is a company called Pipe Drive. So Pipe Drive was founded by 4 or 5 kooky Estonians. A couple of them had come out of Skype. A couple of them were kind of salespeople. One was a community manager. And I was sharing an office at the time with my friend Stephanie, and Stephanie had said, a bunch of 2 of her friends, because she was ex-Skype, were coming to Silicon Valley to meet with VCs. Would you be interested in meeting? And I was like, well, what is it they do? And she said, well, they're building a small business CRM called Pipe Drive. And my initial reaction was like, oh God, SMB, really hard. CRM is like an owned category.
Yeah.
And she's like, but look, one of the guys, his name is Ragnar Sass. So I was like, well, how can I not meet a SaaS founder whose name is Ragnar Sass? And so I met with those guys in my office, and they walked me through the product, which was amazing, but they also showed me their early metrics. And basically off 0 marketing spend, this business was going absolutely bananas. So I wrote them their first angel check. I kind of helped them raise their Series A, wrote a bit more money into that round. And, this business just continued to grow, hyper capital efficient. They probably raised, I want to say 200 million, 250 million. I think when they sold the business, they still had the vast majority of that in the bank. And Vista acquired them for $1.5 billion in 2020, which, and I think they were doing 120 mil of ARR at the time. So, not a bad multiple.
Never say no to these meetings, these coincidences. So you end up making over 40 angel investments. Are you consciously looking for certain traits in these founders? Are you finding similarities? Are you doing it scientifically, or is it more of a gut feel?
As an angel, especially when you're investing as early as I was, it's difficult to apply science to it. I mean, there are signals you can look out for, and I think, in Silicon Valley, people, they're looking for, does this person have a great education? Did they go to a college that's hard to get into? Did they work hard? Were they a college athlete? Because that shows they probably have the grit and determination. But sometimes, it can just be a kind of a feeling that you get from meeting somebody. Could be a special founder, and it's hard to kind of put your finger on exactly kind of what that means or why that is. But yeah, it's kind of it is definitely a gut feeling. And the thing, though, I think, there was a lot of commonality, was that a lot of the founders that I invested in were Europeans or Brits or other foreign nationals who were kind of coming out here. And I kind of feel like if you believe that the best and the brightest are the ones that go and start their own businesses, especially in kind of very competitive spaces, it's then the best and the brightest and the bravest that are prepared to kind of pick up their lives and move to the most competitive startup environment in the world to seek their fortune. And what we saw, and I lived this firsthand as well. Any foreigner who's building a business in the US, they've got a handful of stories around immigration, having to leave the country on short notice, and you come here and it's blue skies most of the year, and the weather, it's great. You've got skiing and beaches and everything else. People just fall in love with the lifestyle, and I think for a lot of founders that come here, they will fight tooth and nail. I mean, they will move mountains in order to make their companies work, because they know if it doesn't work, the US Immigration Service is going to revoke their visa and tell them to go home.
It's very true, and it's a remarkable stat in terms of the amount of founders that have formed unicorns. So many are immigrants. Maybe over 50% are actually immigrant founders, and there are some common traits that you mentioned there about grit, determination, and the plan B being so unpleasant that you just find a way to make it work.
Yeah, and when I look at our portfolio here, the incidence of like foreign-born founders is very high, but there's also a lot of children of immigrants as well. So I think that same kind of culture of hard work gets kind of imbibed into them. They see their parents working 2 or 3 jobs, and so they really, really kind of try hard to make themselves a success.
So you joined Uncork as a partner, which is a huge VC fund. Can you tell us a little bit about your thesis?
Yeah, so I joined the Uncork team in 2015. At the time, it was called Softtech VC. We actually rebranded to Uncork in 2018. And Jeff Clavier, who's the founder of the firm, basically wanted somebody to be like the SaaS expert. My entire career at that point had been in kind of building B2B and enterprise software. Most of my investments had been in kind of B2B and enterprise software and developer tooling. And, and I think Jeff's like, I want you to do the things that I'm not comfortable doing. That's kind of been the message that I've given to everybody incoming as well. Like, we're hiring you because we think that you're world class at something that frankly, I'm probably not great at. The firm, though, is a seed stage venture capital firm. We're currently investing out of our 7th seed fund. So the firm's about 20 years old now. And the current fund is $200 million. The way I describe us is we're a generalist firm made up of specialists. So 5 partners today. Each partner has a slightly different area of focus, but there's also a lot of overlap as well. I today am mainly focused on enterprise software, security, infrastructure, developer tooling. My partner Amy Staper looks at a lot of productivity for EPD, so engineering, productivity, design, and the API economy. So we have lots of overlap there. Almost next to her in the spectrum is Susan Liu. She's our the SaaS queen. We call her the queen of boring. Very, lots of like really unsexy, boring vertical software. Think like the kind of software that you'd struggle to get your parents excited about what they're doing, but we think they're marvelous. Next to Susan is Trip Jones. Trip's our consumer marketplaces and kind of prosumer technology person, and then he also will look at a bit of hardware occasionally. So next to him is Jeff Clavier, and Jeff's the frontier. So I think space, autonomy, robotics, silicon, quantum, stuff like that. So we cover a pretty kind of broad spectrum of areas. I mean, there's certain things we don't do. So we don't really invest in traction-based consumer. We don't invest in media. We don't invest in bio, life sciences. But beyond that, most things are kind of on the table. But with all of that said, today we're 80%, 85% B2B software across the kind of various things that the teams invest in. Average check size when we first invested is about $2.5 million. So, 2-ish on the low end, 3 to 4 on the high end. And the funds are set up so that we can, lead or co-lead seed rounds. We can get involved very early. We often take a board seat, and then be involved with the company through the lifetime. We've got businesses where we might have written the first check, might have been $1 million check we wrote in 2015, but we now, cumulatively have probably $30+ million invested into the company through our seed fund, but then also the opportunity fund that allows us to double down into our winners.
Amazing. Okay, so there's quite a lot of diversification for your LPs because you're playing in a lot of different sectors. How does that translate into your investment committee? Does each partner have final say over what they want to invest into? Or do you have to somewhat agree together?
That's a really good question, and we this is something our LPs ask us a lot about as well. They want to know kind of what's the dynamics in the partners. And as I mentioned earlier, like the people that we've hired are world class in their particular areas. And I think they've seen what great looks like. They've been VCs for 5, 6, 10, 15, 20 years, right? Some of us are former founders, myself and Jeff. Some are former operators, like Amy, she was at Uber, and then Twitter for 4 years, Stripe for 4 years, Accel Partners for 4 years as an investor, and joined us about a year and a half ago. Trip and Susan are both kind of career VCs, so investment bankers turned VCs. And I think what's nice there is it gives us different perspectives. Jeff and I are technologists, we love kind of nerding out on kind of how the next great thing is going to be built. Susan and Trip are kind of much more business model focused, and Amy's kind of somewhere in the middle. But in terms of decision making, I mean, I describe our process as conviction based, where the lead partner will make sure the right person is seeing a deal. So if somebody emails me about a robotics deal, I'll send it to Jeff, and if Jeff's interested, he'll pick it up and run with it. So there's no politicking around putting your arms around the best deals. All of our carry is pooled and shared across the team. But if that deal ultimately looks great, everybody will meet the team at least once, sometimes twice. The lead partner will be spending a lot of time on it, so they're trying to really get to know the founders, understand their motivations, understand the market, understand the risks and the opportunities. And we will ask hard questions of the team, we'll ask hard questions of the partner who is leading it. And sometimes those questions will cause the person to kind of take a step back and say, actually, I think this might not be right for us. But if the partner still has conviction at that point, then that deal can get done, and then it's just a question of economics. I think I kind of want to make sure that we're part of the solution, not the problem, when it comes to like inflated seed round prices. So we can flex up a little bit. I think the size of our fund gives us latitude to oftentimes go kind of toe-to-toe with the multi-stage firms, but at the same time, if they offer like $10 million on 100 posts, we ain't going to do that.
It's probably relief to your LPs that you aren't playing that race, because offering crazy term sheets so early on it's incredibly risky. It's already a risky game, but to make even riskier bets by paying ahead that much is a luxury that only the biggest firms can actually afford to play.
Well, that's right, because I think for the really big firms, it's basically buying optionality. If you're investing out of a $3 billion fund, writing a $2 or $3 million check is like pocket change for them. But if that company ultimately kind of like looks like it's going to begin working, could become like the next OpenAI, then you're just going to back the truck up and put as much money to work as possible. Whereas for us, we don't make these, participatory checks. We don't write just a little bit to see how it goes. If, when we do something, we do it with conviction, and, we're going to write a real check, buy real ownership, and then that will be kind of one of our investment slots. We have 35 investments per fund. That's going to be one of those. And so you've got to be as confident as you can be that this, not only does the deal make sense, but the company has a great shot as well.
Amazing. Now let me flip the table a little bit here and have you pitch Uncork. So you're going into battle against these multi-stage funds. You do have capacity to do follow-on rounds, but you're coming up against big names with a lot of capital that they can deploy. Yeah. What kind of things do you have at your disposal that help you win over founders?
Yeah, I think, some founders, not all of them, but some kind of understand that there is real signaling risk with taking a multi-stage firm at the seed round. There's also risk that, if they're writing a $3 million check and the next day someone's going to write a $30 million check, you're probably not going to get the same care and attention. You're probably also not going to get the most senior people in the firm. You might get a junior partner who's just trying to prove, which is, and these people are typically very, very smart, but not as experienced. And so, we can sell on all of those points. But frankly, I think the thing that allows us to win really competitive deals is our founders. So, our founders who, they will remember who was it that kind of picked up the phone in the darkest days, who was it that kind of rolled their sleeves up and kind of helped with these things. And, they are typically extremely happy to talk to, a CEO that we're courting and tell them, why they chose us and what it's been like to work with us, and, basically say you'd be crazy not to work with them. We pride ourselves on being very hands-on. Not only is it the partners, we have an ops and platform team. We have an amazing head of talent, Adriana. She was the VP of People at Segment, the Chief People Officer at Mural, former recruiter. So she's seen like crazy scale with kind of people operations and how to build these great businesses. Because I think for most founders at the beginning, typically I like to invest in technical teams. There's probably 2 or 3 very technical people, one of whom maybe has a slightly more commercial bent, and so that's going to be the CEO. But you don't worry about their ability to build software. What you want to help them with is the ability to build a company, and that means sales, it means hiring, both bums on seats to build the software, but also people who are going to be out there selling it. And for a lot of these founders, it's their first rodeo, and so kind of having someone like Adriana that can help them think through how to source people, how to interview them, how to check them, how to manage them once they're in is kind of invaluable.
I really like it. So you take a hands-on approach, you limit how many investments you're making, and every investment does count. And founders can do their own due diligence and hear great stories about other founders in the portfolio that have received really hands-on great advice from the partners at Uncork. Did you have a good experience?
There's also a bit of kind of success begets success as well, where the founders will kind of look at your portfolio and they'll see a name that they aspire to being in a kind of similar space. A lot of our developer tools companies see my investment in LaunchDarkly that we want to build the next business doing hundreds of millions of dollars in revenue. And Edith, the CEO, or John, the founder CTO, both of them are very happy to get on the phone and say, this was our experience of working with Uncork in the early days.
And actually, like you said, it's a great signal, because if you're the one that was able to foresee a great giant business before in that segment, you're probably likely to be able to do it again. So when you give them warm introductions to larger funds for later fundraisers, they're going to pick up the phone and answer that call.
Yeah. Although I think, as we like to remind our LPs and everything else, past performance isn't a predictor of future success, but I think there's certainly some correlation. Our job as VCs is we're enablers, right? We enable companies with money, we enable them with time and support, but the founders and the execs and the people building, they're the stars of the show.
You raised $80 million for Huddle. Do you think you had good partners in your VC funds? Are you replicating good behavior that you witnessed, or are you trying to remodel what you experienced as a founder on the actual journey yourself?
Yeah, I think it was definitely a mixed bag. All of our investors were incredibly supportive, and but not not all are created equal. And, I think about Josh Hanna from Matrix Partners. Josh actually stopped being a VC probably 6 or 7 years ago because he was like, I just don't know if I'm any good at this. So Josh, not long before that, led the seed round in a company called Canva, which is probably going to return, that investment alone is probably going to return the fund like 5x over, and he made a bunch of other great investments as well. So it turns out that Josh is actually a very good VC, but he just decided that kind of like GP firm life wasn't for him. The most impactful stuff for us was the connectivity. You live in Silicon Valley, you build a great network, you want to be able to kind of open that contact book up to your founders. I think there's definitely kind of social currency. People here, they love the idea of kind of paying it forward, but I think it's also like if you've helped them out, they're also very, very happy to then kind of return the favor. And you never want it to feel transactional, but I think if you build good relationships with people, they will bend over backwards to help you in your portfolio. And I think the other thing to remember is, as VCs, right, our hands shouldn't be on the steering wheel. Maybe we're kind of holding the map and providing some directions, but ultimately it's the founders who are driving the car. And I think what I've seen with a lot of VCs, especially former operators, is they come into the role and they hate it because they want to roll up their sleeves and they want to get their hands dirty and they want to get hyper involved. Whereas I think in our job, the most limiting factor you have is time. And maybe at the very beginning in your first investment, you might be able to do that. But when you've got a portfolio of 20 or 30 companies, you've got to be really measured about like how can you provide the most utility to your founders per kind of hour you're spending on something. And that means, leveraging the network, leveraging the team here, leveraging everything else we have at our disposal that doesn't require me to be kind of spending 5 hours a day on a particular company.
That makes a lot of sense, and it's wise words. So if I was to push you and ask for a specific example of a crucible moment, maybe some monumental door or introduction that you gave to a portfolio company, is there a specific one that comes to mind in terms of you're proud of making that impact at that time? I mean, this isn't an introduction, but it was certainly kind of a situation that I was able to kind of help manufacture. So one of our portfolio companies called Fountain, they're an HRIS for frontline workers. I think like Workday for people working in restaurants and grocery stores and part-time contract type work. The founder, CEO Keith, is Korean, and he came back from a trip incredibly homesick. He's a young guy, and we sat down. He's like, I just don't think I can live in the US anymore. I came here for college. I've been here since, but I really want to move home. I was like, well, that's great, Keith, but you're the CEO of a venture-backed company that's raised like $40 million at that point. So we need to think about timing. Like what we think is like, well, I was kind of hoping that I could move back in the next 30 days. I was like, all right, mate. Well, that isn't going to work, but let's. I'm a big believer. If somebody's heart is not there, if they've got like 1 foot out mentally already, there's no point in trying to hold on to them because they're going to be thinking they're just. 30 days is not a great handover period. It's not enough time to find a replacement.
So we ultimately got Keith to stick around for much longer than that, but we kind of got to work immediately on kind of figuring out who would be the successor. There was a board member. He was the first angel investor in the company. He was also their first customer at his last business, a company called Stratim, a guy called Sean Bear. And Stratim was being sold around the time this was going on. So Sean's calendar was actually beginning to free up. And so Sean said, look, not long term, but let me step into the interim role as CEO. I know the team, I know the product, I know I'll help you hire the right person. So he and I basically tag teamed on interviewing, meeting, diligencing potential CEOs. And we probably met with 5 or 10 incredible people. And this was kind of very early COVID. I remember kind of meeting up with Sean, and this was still kind of when you were outdoors, you had to sit 6 feet apart because people knew, I had no idea how this was working. So we went for a walk in Golden Gate Park. And we talked about the various candidates, and I was like, but Sean, to my mind, they're all great, but I just don't think they're as good as you. You should take the job. And so I then spent a week working on him to kind of get him comfortable with the idea of moving from interim into full-time CEO. He did it and has just crushed ever since.
Amazing. Sometimes you hear VCs being villainized, where perhaps the founders underperformed and then they've had to replace the management to get in a bit more energy, maybe a new approach on the go-to-market. But actually that is very much founder-driven. I'm not up for this. Let's manage transition in a new manager. put in a new CEO and move forwards.
Yeah, and that's kind of like the fun part of the job. There's always going to be situations that aren't fun. It's going to be, as you say, it's the founder that has to be moved out for whatever reason. They're underperforming. There's kind of relationship issues there. That's not fun, but it's kind of like a necessary evil part of our job. I think if you're going to be a great VC, it's not just about the initial investing. It's not just like the sourcing and the picking and the winning. There's also then the cultivation. Your job is to kind of not just make that great first investment, but then help the company kind of grow into something really big and successful in the long term. And sometimes that means taking steps that are difficult.
Very true, very true. Are there any misconceptions that you think founders have when they're raising venture capital that you would wish they knew? I know it's quite well written about, but do you still see common items coming up that cause friction with VCs that founders should be aware of?
Yeah, and I guess what I'd kind of brief add here, I'd probably say if anybody hasn't read it, Brad Feld's book Venture Deals is fantastic. It's kind of like demystifying a bunch of stuff that that you'll see in term sheets, that you'll hear in VC conversations. But zooming out though, I think there's really kind of two things. Like most founders don't understand the business of venture and kind of how venture funds work. I had to learn this kind of like firsthand in the job, and you see like a very small part of it when you raise venture, and you see a part of it when you're angel investing, but you're really kind of just peeking through the curtain, and it's only once you're inside a fund you understand a bit about portfolio construction, reserve strategy. As a seed investor or even a Series A investor, you cannot like back a company into perpetuity. Your funds typically aren't big enough. You have to bring in fresh capital in order to make it work. I think the second thing is that a lot of founders kind of don't really appreciate where the money is coming from. So like most kind of institutional VCs now, we have a mixture of some very high net worth individuals, but the vast majority of our money is coming from endowments and charities and foundations. You have to be mindful that we're investing pension funds, we're investing the funds that are going to help like orphans and widows, and so we have to be making as good a decision as we can at any time. And I think we found ourselves in this startup period where anybody could raise a Series A, maybe a Series B, and money was effectively free. And post kind of March 2022, that just all went away, and raising capital got incredibly hard, especially growth stage capital. Now, we have a bunch of portfolio that were like the great beneficiaries of timing and good luck in that they raised big rounds in Q1 of that year, and so were very able to very quickly kind of slam on the brakes and adjust their business plan. I think it's the companies that had raised a year or two before that who were kind of getting towards the end of their runway and hadn't like really built enough to kind of build into the valuation they perhaps had. That's where there was going to be issues.
I think it's incredibly healthy for the ecosystem. I know it's painful to readjust, but it was going bonkers. So valuations needed to come down and capital needed to
valuations need to come down. I think companies. It's not a bad thing that companies don't work. That's just the natural order of things. And I think unfortunately too many companies were able to survive for too long and soak up too many venture dollars. These companies should probably have ceased to exist a year or two, 3, 4 before they actually did. So I kind of feel like we're now back to more of an equilibrium.
Okay, taking a positive turn now. What have been the largest wins in Uncork's portfolio?
Yeah, I mean the names that people would know. Jeff was a very early investor in Fitbit, which was a huge outcome. Very early investor in Eventbrite. Very early investor in SendGrid. Very early investor in Poshmark, which is a kind of used clothing marketplace here. Was a public business and ultimately acquired for like $3 billion. Early investor in a company called Fungal, which is actually a UK founder. Here BlackRock bought it for almost $1 billion. And then lots of other kind of onesie twosie type companies. But when we think about the businesses now, that if we were to say who are the kind of 5 most exciting companies in the portfolio today, looking at the later stage companies, LaunchDarkly, which is a developer tool, feature management platform doing hundreds of millions of dollars in revenue now. Human Interest, which is a 401k, so kind of corporate pension plan provider. I think that will be a public company in the not too distant future. Orbital, which is a space tech company, so you can kind of guess that's probably one of Jeff's, which it is. And that business now doing hundreds of millions of dollars a year in revenue. So there's a bunch of good stuff, and I mean I would love to have been in a position where we had like one IPO a year, for the last like 5 years. Unfortunately, the IPO markets have been closed, and even the M&A markets have been pretty closed. So I think with the hope for this year is that we begin to see a drip of new IPOs coming through, and not just the really big ones, not the just the Stripes and the Databricks and potentially the OpenAIs, but actually the $3 to $5 billion companies, that have been private for too long that need to go out because they're great businesses, and it's insane that a business that's worth $3 to $5 billion doesn't feel the confidence to go and debut on the public markets, and hopefully that will change.
Okay, I love it. You're talking about IPOs and public markets there quite heavily. But are trade sales more common, less common? B2B SaaS, you tend to get very good public multiples, but I would have thought that the private market acquirers should also be warming up again with interest rates coming down.
Typically, yes. It's not just the interest rates here. The other thing is the big buyers have felt very hamstrung by
regulation.
By the government, their ability to go and do deals. I think Microsoft and Google, I was chatting with some bankers at Goldman a couple of months ago, and their view is that right now they feel under the current administration or under the past administration, they had kind of one bullet a year they could use. Be damn sure that bullet was the right one. I think now, though, they're going to be a lot more open to kind of looking at other deals and doing stuff. And it doesn't have to be the Activision style $25 billion outcome. It could be the business that they're acquiring for $250 million or $1 billion or something like that.
No, it should be really good. Gives your fund liquidity, gives your LPs a bit of liquidity there. We can't wait for it to happen. Before I move on to the Founders Pledge, I'd just like to know about any interesting anti-portfolio companies that you might have come across, maybe just one or two anecdotes, and why they weren't right at the time.
I think every investor that's been doing this for long enough kind of has a few, and it's also it's very unclear, especially when you invest as early as we do, kind of what's actually going to ultimately hit the anti-portfolio. I think for me, a couple that stand out were Sneak and UiPath. I was offered introductions to them. They'd actually already raised seed capital, and they were open to raising more, but it was at a price kind of much higher than we would typically be comfortable writing at the time. And I was still finding my feet. I'd only been in the firm for a handful of months, and so I didn't feel like I at the time had the experience or the agency to go and do something that was kind of off-piste. In retrospect now, I probably could have invested in UiPath at $15 or $20 million, which I would do that all day long today. And probably, Sneak was probably even less than that. But, so it goes. It's fine.
The best investors have those moments. It's not clear, and you have so many wins, it doesn't really matter what's on the anti-portfolio.
Yeah, there's a guy called David Hornick, who formerly August Capital, now has a fund called Lobby VC. And I remember being in a session with him where he was talking about this, and he passed on a company, and the founder wrote back and basically said, well, I think that's a really bad decision. You'll rue the day. You'll really wish you'd invested. And he's like, look, you might well be right, but it's like I passed on the ability to invest in Facebook at a $10 million valuation, so I'll probably be fine.
There'll be something hurting more. Okay, I love it. Okay, so that's Uncork, and now I'd love to get a bit more information on the Founders Pledge, which you co-founded. It's a phenomenal cause that has over $11 billion of founder donations pledged to giving away their money to charity.
Yeah.
What inspired this?
Like having been there from the very beginning, and I would say it's very kind that David, who's the CEO, said that I could be a co-founder because he did 99.9% of the work. And my job in the early days was to we worked together on the initial brand, we worked together on the messaging, we worked together on the contract, and I kind of had this idea because I remember being at a party. Probably back in 2012 in New York and just kind of looking around the room. Scott Harrison from Charity Wharton was saying most people in this room don't have liquidity today, but they have future liquidity. Wouldn't it be really cool if you could build a pledge where, they would say upon liquidity, and it could be partial liquidity from a secondary, it could be a trade sale or an IPO or whatever else, that they will donate a percentage of that to the charity. And it doesn't matter if you have a $1 million outcome or a $10 billion outcome, a percentage of that will go to the causes that you care about.
It's easier to sell something to someone that doesn't have the money yet.
Exactly. Yeah. Why wouldn't you? It can be made very tax efficient as well. Now, I was kind of having this conversation in the US, and David, who's actually weirdly an American but living in London, had been having the similar conversation with the team at Founders Fund. At Founders Forum, so Brent Hoban and co, about setting up a charitable wing of their organization. And the old story about monkeys on different islands developing the exact same habit. It was like that. We were introduced by a friend, and we're kind of immediately simpatico. We realized, we had exactly the same vision. Now, my problem was that I had a full-time job, and I could only spend so much time on this. David's problem was that he wasn't particularly well connected into the ecosystem. He was the driving force behind it, but I was able to help with introductions. I was able to help with some credibility, and I kind of feel like it's a bit like as a startup, kind of making your initial sales. You kind of pick someone who's just a little bit out of reach, and you sell to them, and that gives you then the latitude to go and sell to somebody even bigger. And it kind of happened like that. We would. We got a bunch of the founders of my portfolio signed up, and then you blink, and all of a sudden you've got people from WeWork and Uber and like amazing, like UiPath and amazing names like that, kind of signing up. In fact, and several where we're not allowed to talk about them, but these are some of the most successful entrepreneurs on the planet.
And what is the pledge? It's a percentage of how much you might make in the future, and then you lose control, then it goes to the charity and the charity distributes it, or you have more control over how it's distributed than that?
Yeah, I mean, one of the things that we've done over the last 5 years is set up a research part of the Founders Pledge. And so as a founder, like you would talk to the team there and they'd be like, okay, Harrison, what do you care about? You say like, well, I care about malnutrition in children. I care about animal welfare. I care about this, that, and the other. And what they will do is kind of basically come back to you with a set of recommendations on the most high impact charities. Because most charities that people know with the brand names are actually not particularly efficient.
There's a leaderboard of the worst charities in America as well. That some of these organisations raise $100 million a year, and they take it all out in consultancy fees, which is an absolute sham. They should be imprisoned.
And they distribute 5% of that, whereas the most impactful ones, of course, everybody has running costs, but the vast majority of donations end up going to the charity. So what the team will do is kind of help you figure out where that money should be going to. You basically then create this pre-allocation to say 30% to this charity, 30% to this charity, 30% to this charity, and then when liquidity happens, I mean, and it is a pledge. So a lot of this is kind of on the people to fulfill the pledge. But then they'll say, well, look, I made $100 million in selling my business, and I said I was going to give 10% of that to charity. So I will put $10 million into my Founders Pledge DAF, and then you can distribute it as per,
Amazing. Okay. And so does Founders Pledge then control how it's distributed? It's not a one-off payment to these charities, it's maybe multiple.
I mean, I think that they work with the pledger on that, but oftentimes it's going to be a one-off distribution, unless, the person wants to continue making investments in the DAF.
Are there any particular campaigns that you're particularly memorable about donations actually getting to charities? Has it started making distributions?
Well, I mean, yes, there's been tons, and I sat on the board of the Founders Pledge up until about 6 months ago, and so every quarter we'd go through and kind of review and approve tens or maybe hundreds of millions of dollars of donations that would be going to all sorts of charities. And as you can imagine, like with a bunch of Silicon Valley people, a lot of the money was going to AI safety and AI alignment. But there's also we saw a lot of kind of medical research. We saw a lot of kind of societal impact stuff as well. And the nice thing is, Founders Pledge isn't being prescriptive about where you donate your money. They're just helping to make sure that whatever the kind of chosen cause is, it goes to the very best charity serving that.
Wow, what a phenomenal organisation, and what a huge impact they're going to have on society. Thank you. Thank you on behalf of everyone else in the world. Founders Pledge is doing the world a lot of good. And I think that's us out of time as well. So thank you very much for coming on the podcast.
My pleasure. It's been a lot of fun.
Thank you.